halfway through the earnings season, and let's take a look at how earnings so far have been. And first up, let's start with the Nifty 50 pack and the number of companies that have reported earnings above street expectations. Now, about 34 out of 50 Nifty companies have already reported their earnings. 14 companies have managed to beat street expectations. 8 have been below street expectations. 12 in line, and 4 companies have reported a mixed bag. So that's how the Nifty 50 scorecard so far has been. Let's also talk about what brokerage houses are saying. Now, Citi is saying that the companies under their coverage have reported earnings better than expectations, and this is 4% ahead of their estimates. Morgan Stanley, meanwhile, says that revenue growth of about 19% is what the industry has reported, 6 percentage points ahead of their own estimates. Motilal Oswal, meanwhile, has also gone ahead and said that the numbers have largely been better than what the street was working with. So across the board, the consensus saying is that the numbers this time around so far have been better than what the street was working with. Let's also talk about the 3 factors that weighed heavy on the numbers in the quarter gone by. First, of course, was the input cost inflation led by West Asia crisis. Second is net interest margin pressure, especially for banking companies, and mounting losses for oil marketing companies because of the surge in crude oil prices that we have seen in the global market. These are the 3 factors that largely were weighing heavy on earnings season in the first quarter of FY27. Now, Citi says that consumer durables, especially discretionary auto and durables, have delivered better than expected growth. Morgan Stanley says that average EBITDA growth stood at about 20%. The strongest profit growth came in for utilities, materials and financials. Industrials and utilities were leading the beat this time around, and consumer staples were some of the laggards that we saw in the quarter gone by. So this is what Morgan Stanley has to say with respect to specific sectors and the kind of performance that we saw in the quarter gone by. Meanwhile, Motilal Oswal also has come out with a report where they say that the upgrade to downgrade ratio stands at 1.6 times. In fact, they say that 70 companies have been upgraded versus 45 companies which have seen downgrades this time around, and hence the ratio stands at about 1.6 times. RIL, Bajaj Finserv, Shriram Finance, Nestle and ICICI Bank, these are the companies which saw FY27 upgrades as far as earnings estimates are concerned. And on the flip side, Interglobe Aviation, Dr. Reddy's, Tata Steel, Wipro and Maruti Suzuki, these are a couple of other stocks which have seen downgrades as far as FY27 earnings are concerned. Motilal Oswal now has financials, auto, new age, manufacturing, industrials and discretionary as their key overweights, and private sector banks, staples, energy, telecom, commodities, utilities and renewables as the key underweights in their portfolio. So this is what the brokerage houses have to say with respect to the earnings gone by. Now, several factors which will continue to remain at play going forward as well. First and the most important has to be geopolitical crisis with respect to the US-Iran war and the developments that take place there. Monsoon progress, which has been below normal so far. Cool off in input prices, which is expected to happen and will perhaps aid margins in the coming quarters. Domestic demand environment, especially rural demand if monsoon is below normal. And the AI trade, and India largely being known as an anti-AI trade, will be another factor to watch out for. So these are the 5 factors which will determine the trend for Indian equity markets going forward. But largely, the consensus has been that earnings so far have been better than what the street was working with.